What's up, guys? It's Tiff, back again to talk more about Celsius. Today we're going to go over lots of issues like how long exactly was Celsius insolvent? Were they always paying out our rewards from the funds of new investors? In other words, were they a Ponzi scheme? Were they buying and manipulating the price of CEL Token in order to boost their balance sheet? As well as the potential hiring of an independent examiner or U.S. Chapter 11 trustee. And lastly, we'll go over David Leone, one of Celsius's co-founders, who recently declared his shares in the company worthless. First of all, a new filing by the Vermont Department of Financial Regulation makes the case that Celsius was effectively insolvent not just after the crypto markets declined earlier this year, but as early as 2019. According to the filing, about 40 state regulators are now looking into the operations and financials of Celsius. As stated in the filing, during the course of the multi-state investigation, it has become clear that Celsius, through its CEO Alex Mashinsky and otherwise, made false and misleading claims to investors about the company's financial health and its compliance with securities laws, both of which likely induced retail investors to invest in Celsius or to leave their investments in Celsius, despite concerns about the volatility of the cryptocurrency market. The filing then goes into specific examples of when Celsius and Alex Mashinsky were dishonest with us. For example, when Alex stated that Celsius has the reserves and more than enough ETH to meet withdrawal obligations, as dictated by our comprehensive liquidity risk management framework. However, preliminary internal financial records provided by Celsius to members of the multi-state regulator group show that Celsius had a deeply negative net worth on June 7th, the date that tweet was posted. They lacked sufficient assets to repay its obligations to depositors and other creditors, and had ETH-denominated liabilities in excess of its ETH-denominated assets. The filing then goes on to again and again note specific dates that Alex Mashinsky made public statements claiming Celsius's financial health, and contrast this with data showing that Celsius was actually in the red in most of these moments. In fact, during the 341 meeting, Celsius admitted through its CEO, Chris Ferraro, that the company's insolvency started with financial losses in 2020 and through 2021, belying the claims in Celsius's first-day declarations that the company's insolvency stemmed from the fall of the crypto markets during spring of 2022. In other words, Celsius must have known about their insolvency for a long time, so this wasn't just a run on the bank due to crypto markets' downturn earlier this year, and it also clearly contradicts everything Alex Mashinsky has said in interviews. In fact, in the 341 meeting, Celsius even admitted that the company had never earned enough revenue to support the yields being paid to investors. This shows a high level of financial mismanagement and also suggests that, at least at some points in time, yields to existing investors were probably being paid with the assets of new investors. In other words, the literal dictionary definition of a fucking Ponzi scheme. If you can remember, this is exactly what Jason Stone, former head of DeFi at Celsius, accused Celsius of even before any of these numbers came to light. In short, as summarized by this CoinDesk article, contrary to voluminous public statements by CEO Alex Mashinsky, Celsius never really functioned as an investment middleman for crypto asset holders, generating yields from institutional lending and passing them along to depositors. Instead, nearly from the beginning of its existence, it was paying depositors, at least in part, from non-revenue sources, including other depositors' funds, venture capital investments, or the CEL token it printed from thin air. Furthermore, the Stretto filing claims that Celsius and its management engaged in the improper manipulation of the price of CEL token, including by using the proceeds of investor deposits to acquire CEL tokens and increase its net position in CEL. In fact, from May 2nd, 2022 to July 1st, 2022, Celsius increased its net position in CEL by an additional 40 million CEL tokens, with over half of this increase occurring after Celsius froze withdrawals on June 12th. In other words, Celsius spent hundreds of millions of dollars worth of depositor funds buying CEL tokens with the possible intent of pumping the token price, including after Celsius halted withdrawals on June 12th. By increasing its net position in CEL by hundreds of millions of dollars, Celsius increased and propped up the market price of CEL, thereby artificially inflating the company's CEL holdings on its balance sheet and financial statements. Excluding the company's net position in CEL, liabilities would have exceeded its assets since at least February 28, 2019. These practices may have also enriched Celsius's insiders at the expense of retail investors. In other words, if this is all true, Celsius was effectively insolvent 2 years into operation. It seems that the way they were able to avoid acknowledging their insolvency was by buying, inflating, and tallying up their CEL tokens. The filing states that by increasing its net position in CEL, Celsius invested depositor assets in a long position in CEL that was inconsistent with its purported market-neutral investment strategy. During the 341 meeting, Celsius admitted through its CFO, Chris Ferraro, that the decline of price of CEL contributed to its insolvency. So, as a result of all of this lovely information, Vermont regulators are requesting an independent examiner to investigate whether or not the company's actions and practices improperly enrich Celsius insiders and other holders of CEL tokens at the expense of retail investors in earn accounts. Vermont respectfully requests that an examiner be appointed with broad powers to investigate the debtors and their financial affairs. So I think we can all agree that we'd all like a little bit more transparency from Celsius. However, in a Twitter space last week that I covered in my last Celsius video, David Adler, a bankruptcy lawyer, did express some of his concerns and some cons of hiring an independent examiner. Well, as a result, David Adler and his team at McCarter & English filed a counter to this request for an independent examiner. In Adler's filing, posted on Stretto yesterday, he and his team agree that the court needs to appoint an independent, neutral third party to conduct an investigation into the debtor's operations and conduct pre-petition. However, instead of an examiner, Adler and his team proposed the appointment of a Chapter 11 trustee. He then goes on to outline some of the reasons for this suggestion. First, the borrowers are concerned that the wide scope of the examination proposed by the U.S. trustee will significantly delay the resolution of this case. Given the current monthly cash burn in this case, this delay will cost the estate tens of millions of dollars. Second, during the examiner's investigation, the focus of the estate fiduciaries will be on past conduct and may be distracted from focusing on transactions that can maximize recoveries to creditors. Third, assuming that the examiner concludes that there are colorable claims against the debtors, management, and third parties, it is unclear who would prosecute them. Obviously, given the pre-petition management is still in possession, the debtors would not be pursuing these claims. For these reasons, the borrowers respectfully submit that the appropriate remedy is the appointment of a Chapter 11 trustee. The Chapter 11 trustee can investigate and prosecute claims against parties and determine the strategy that maximizes recovery to creditors. So essentially, it sounds like overall the appointment of a Chapter 11 trustee over an examiner would cost us less time, less resources, and ultimately less money. So what do you guys think? I'm going to assume that most of us are also not lawyers, so I don't personally understand the nuances and differences between a Chapter 11 trustee and an examiner, but I am actually a little bit concerned about some of the issues that David Adler raises about the appointment of an examiner regarding the amount of extra time it would take in the bankruptcy and the amount of cash it would end up burning. But who am I to judge? I don't know. I'm not a lawyer. Anyways, last brief topic. In a recent filing on Stretto, David Leone, co-founder of Celsius, declared all of his equity and shares in Celsius as worthless. It seems kind of obvious to me that shares in Celsius are currently worthless, but this could just be him trying to get a tax write-off, so I don't think there's that much more to report here. Lastly, I did make a recent video explaining the Ethereum merge, but just to tie that back into how this might affect Celsius, I would just like to say that any of the ETH that Celsius has staked to the beacon chain right now earning interest will not be available for withdrawal until at least 6 to 12 months after the merge is completed. In other words, assuming that a lot of Celsius's ETH is currently staked to the beacon chain in order to earn interest, all of that ETH is currently insolvent and will not be solvent for quite some time, potentially up to a year. Maybe more because Ethereum is notorious for delaying upgrades. That's about all I have for today, but last but not least, I will leave you with these incredibly tasteless products by Chrissy Mashinsky's USA Strong Company, such as Celsius Sopoly, and a shirt that says, "Unbankrupt yourself." In some ways, I'm in utter shock and disbelief, But also, this bankruptcy has never ceased to amaze me, and it's all a fucking disaster. So, here we are. Feel free to like, comment, and subscribe to my new YouTube channel. I will continue to bring you Celsius updates and whatever other updates you'd like to see from me. I also respond to pretty much every comment that I receive, so I will see you down there. Goodbye, everyone. I love you so much. Howdy, this is my Marvel style end credit scene.